Welcome into a brand new episode of WSI TV. Enjoy the show.
Welcome back, everybody, to this episode of Jim's Market Update. I am Taylor Clinkfield, and I'm joined, of course, by our market expert, Jim. How are you doing today?
How you doing? Thank you.
Awesome.
Having me.
Great. So before we get into this week's update, I do want to remind you guys to go to WSITV.com. There you can sign up for all of our free daily newsletters and get all of our awesome content, and you get instant access to the WSI Vault. So, before we jump into everything, do you want to just give us your general market update and rundown as to what's going on this week?
Yes, so just as an overall summary, the bull is still sitting here, fat, dumb and happy, just like the overall market, and we said as much on September the 9th. That was our first call of, our system. The proprietary system we used got us into the market in November 2016, enjoyed a big bull, run up there for a couple of years, like 20% gain actually, put us back into cash last October, had us in cash for quite a long time.
Yes.
But just as I say, September the 9th, he came back, and that's where we're at right now. And it seems like all the kind of the pundits and the talking heads are only just starting to maybe come around to the idea that it might be a bull, So, but we watch, the market's going to tell us what's going to happen next. But overall, yeah, I mean, we're still not through October yet. Volume is still a little bit low, which is, reflects the concern that's possibly still out there. The conviction's not there totally. One confirmation we are getting though is that the Treasury bonds, which just have been flying high, like crazy high, which are traditionally a sign of fear, because Treasury bonds are safe, and so this rush into Treasury bonds of late was obviously a concern that was, that was a fly in the ointment of the bull's case, but only just now that they seem to be they're topping out, looking vulnerable, which confirms the stock market case. So it's looking better all the time. The chart is undeniably aggressive, and heading into November, December, the positive time of the year traditionally, should be all good, especially if we get back out to that new high of 3,000, the psychologically important 3,000, get above and stay above, and then I think all is well.
Very good. Awesome. So with that, we are looking at certain indexes for the market. There is one that caught my eye that I wanted to get your opinion on. Apparently the uncertainty index is higher now than it was after 9/11, after the European debt crisis, and after the election in 2016, which obviously says something different than what we're saying. So what do you think about that, the volatility there?
So the uncertainty index is measuring volatility, or is it? Because that's a good point as well, because I always have to be careful of when we look at these indexes, when we hear these headlines. It's a good point that comes up, because what is it based on? Exactly. For example, the VIX, the volatility index on the VIX, is based on the number of, the put options, the amount of short interest there is on the S&P 500. So you've got to be just always mindful of what is it actually reflecting. So with that in mind, I think that's why, again, why bonds have been so high. There has been that uncertainty. There's all this chatter of trade wars, and to be honest, a lot of it, I think, has been brought on by, the media winding people up. But and again, it's flying in the face of what the actual stock market, the S&P 500, is doing. So yeah, let's talk about that. There's Brexit, which looks like it's having some breakthrough now. That's the market just hates uncertainty. But the other thing we have to bear in mind is that these indexes are forged by traders, investment funds particularly, the big institutions who can't even beat the market 70% of the time. So sometimes it's good to take these indicators as contrary, because if too many people get on one side of the trade, it's always a flag, which, if that's where you're getting extremes on this uncertainty index, it could be taken as a contrary indicator, because when everybody's thinking the same thing, nobody's thinking, right?
Very true. Yes. So that's interesting to hear. We do also have to talk about that the retail report came out last week, and people were kind of disappointed. The numbers for consumer spending went down, which if you guys have been following the economic news recently, you notice that's everyone was hanging their hopes on that. So we're hoping that with that Santa Claus rally that's coming up, as you said, we're not through October yet, that we're going to see that retail spending come back forward again.
I think the Black Friday figures particularly are going to be, and the Cyber Monday as it is now, are going to be watched particularly closely this year. A lot of hopes are being pinned on, you know, as you say, on consumers. But again, not forgetting though that we have got this kind of two-tier world where what the average person in the street has to put up with is not what large banks and so on and large tech companies have to put up with. So there's definitely this mismatch that's always good to be mindful of as well. But yes, there's always things to watch for, and if this market is pinning all its hopes on consumers, then as I say, this holiday season can be very important.
Yes, very much so. Yes. So as you mentioned, we are going to be continuing monitoring these things. We are following the Brexit deals as they're happening. We are watching as the extensions keep coming, and just going to see what's happening over there. Just in general, we're looking for growth in the future, correct?
Yeah, and that I think that's one thing that the Fed Chairman Powell is wising up to now. You've got a presidential. The reality is you've got a presidential election coming up. His boss is the president. He's supposed to be disconnected. In reality, he wants his boss to stay in, and they're going to, I think, start juicing things more. That's bound to have effect. Low interest rates can create a flurry of activity. Just more steroids into the consumer, should fix that. Barring any, exogenous shocks, like we hear about, Turkey and things like that going on. But those things will always be there, and we can't, and that's an important point. We're not clairvoyants. We don't try to predict the future. We go by what the market is actually telling us to do. And I think that's really the most successful traders, most successful market watchers. They don't claim to have a crystal ball. They just go by what we can see right now, what the market is telling us to do specifically. And right now it's saying game on.
Yeah, awesome. So what we're seeing on right now, you guys, is that duplicity we talked about a little bit, the average trader versus the big institutions that we're kind of up against at all times. I think that gap is going to widen a little bit, but obviously we've got a bullish outlook right now. We're going to try and follow that into the following months, and I think that's a good outlook for you guys to see that we're going to be successful no matter what's going on, because we are following the market. Yeah,
and short term, it's looking like it seems to be off to a good start this week as well. So that's always an important point too. What's happening this week?
Awesome. Yeah. So thank you very much for your insights, Jim. Yeah, we're looking forward to see you again next week.
See you next time.
And tune in for the following episodes that we're going to have later this week on WSI TV. See you next time, guys.
Thank you.
Thanks for watching the latest episode of WSI TV. Be sure to visit WSITV.com, where you can subscribe for free with no contract and gain instant access to the secrets of self-made millionaires via the WSI TV Vault. So go ahead and claim this gift for free now at WSITV.com.